In my last video, I mentioned that my investment portfolio was heavily weighted in individual corporate and municipal bonds with a substantial weighting in treasury bills bought at the weekly treasury auctions that mature in less than 1 year. I still own stock and stock funds, and the current gyrations of the stock market is creating all the excitement that I can stand with what I now own. I have only a very minor weighting in treasury notes and CDs. I am allowing my CDs to run off without buying new ones. I had bought several CDs when the coupon was over 5%, and some of them have not yet matured. I'm keeping my weighted average bond duration, which includes treasury bills, near 3 years for several reasons that include my age and financial condition. The main reason, which is the subject of this video, is that a reasonable future forecast, based on what is known now, is that inflation will start to accelerate later this year and may go back into problematic territory by mid-2026 or late in 2026. And by problematic, I'm referring to an annual CPI inflation rate of 4% or higher. There are several events occurring now that will, in my opinion, place upward pressure on consumer prices, and not all of them are obvious. One that is obvious is the Trump tariff taxes. Once you realize that the U.S. importer will be paying the Trump tariff taxes, not the foreign country whose domestic companies ship the products to the United States, as Trump claims, then it will become obvious that increasing U.S. tariffs will increase prices paid by U.S. consumers. While some importers may eat part of the tariff tax and accept a lower profit for a while, the Republican tariff taxes, like any other input cost inflationary factor, will be passed on to U.S. consumers, either all at once or over time. And if the tariffs remain at the same level, there will be like a permanent increase in the cost of those products. The second inflationary pressure related to the Republican tariff tax is that the U.S. dollar is declining significantly in value against foreign currencies this year, which make imports even more expensive. I read an interview with a Morgan Stanley global strategist who opined that the U.S. dollar will continue going down in value and would lose another 9% or so of its value by mid-2026. The U.S. dollar is already down about 10% this year against foreign currencies using any of the dollar indexes that track the dollar's value against foreign currencies. Devaluing a currency, which is what is happening to the U.S. dollar now, creates inflation. The third major inflationary factor will be major supply chain disruption, similar but not as bad as what happened during and after the pandemic that was a major cause of the problematic inflation in 2021 and 2022. Supply chain disruptions that are about to happen will have several causes, including the mass deportation of undocumented immigrants who work in agriculture, and that is occurring now in California, construction, small factories, and in processing plants for various meat items, hog, chicken, cows, etc. Another supply disruption will be caused by firms simply going out of business who rely on foreign steel, aluminum, and or copper that are now subject to the 50% Republican tariff taxes, which will create shortages when they cease operations. U.S. production of those metals will not be anywhere near sufficient to meet demand from domestic producers who use those metals in the production process, as the firms who do survive, they heavily use those metals, will demand more product from the U.S. suppliers who simply do not have the product to sell, so prices will increase. Another factor that will add to inflationary pressure is the recently passed BBB legislation through the tax cuts, and I'm talking about uh, not only extending the existing tax cuts, but adding new cuts for Social Security benefits, overtime, tips, and other things. Without the other inflationary factors present that I just described, more after-tax income for households would not be inflationary. It is generally a positive whenever consumer spending can be sourced from disposable after-tax income rather than consumers adding more debt. One of the most powerful and positive economic forces over the past 2 decades, which I've been discussing for over 20 years now, involves the refinancing of home mortgages long term at much lower rates than existed prior to the mid 80s, which increases over a long period of time disposable income after debt service payments, which can be used to fund consumer purchases rather than assuming more consumer debt, or to pay down high cost debt, or to save. Fiscal stimulus will cause some inflation through increasing demand at a time when supply chain shortages develop. And I suspect that will start to happen soon. It will take time, for example, for the deportations to reach a level where they have a significant impact on the supply chain. You remember that the stimulus checks that were sent out in the last year of Trump's term and during Biden's term, that is the kind of fiscal stimulus that can add to inflationary pressures when there are supply chain shortages and an increase in consumer demand. The inflationary impact in 2021 and 2022 by those stimulus policies was aggravated by demand suppression during the pandemic and then a massive acceleration in pent-up demand as the pandemic faded, but the supply chain shortages remained. I will link some videos in the More section below where I discuss why I prefer owning individual bonds rather than bond funds. I will also revisit that topic in my next blog post. I have some inconsequential holdings in bond funds that are simply temporary holdings, which I plan on owning for no more than a year. And there are alternatives to keeping funds in my Schwab sweep account that pays 0.05%. I discussed in my last post published on July 22nd eliminating 3 tiny positions in bond funds in that account. See item number 7 titled Bond ETFs, where I also discuss why I do not like them. I would recommend going to the Morningstar website, enter the symbol of a bond fund that you own or are interested in, and then click the Performance tab, which will have the annual total return numbers, and that total return is with dividends reinvested. That information is accessible to non-subscribers and hopefully will open your eyes if they are not already open to the issues.